There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome everyone to the Monday version of the Saturday Software Strategy and occasional ramblings by yours truly, Steve Vetterl. On behalf of Auvoria Prime, I act as your risk manager. I'm acting in that role Monday, even though I acted in that role Saturday and it didn't record. So let's try again. Let me go ahead and share screen. So as I talk a little bit about on Saturday, let's try and do the finviz.com overview first. If you guys are not familiar with this, it's just finviz.com. You always want to make sure you click on the daily charts here. In my opinion, I just prefer to look at a longer term on the grand picture of what I like to call the dashboard here. And I want to see the charts so we can see what's going on. Equities are always at the top. So we have essentially the dead cat bounce playing out that I talked about, starting to pull back down as we're coming into corporate earnings season. We're going to see whether or not all of the inflationary factors are going to begin to sort of play out in the marketplace for all the different companies. It certainly could be an issue. Crude breaking below 100, sort of essentially the energy space coming back down. But as almost all energy is definitely elevated, continuing through the commodity space, we see cream of wheat's hitting an all-time high. Just kidding. Oats are hitting an all-time high here. Looking at OJ, thinking I have to switch from my vodka orange juices to something else. Although if I'm looking to build a house soon, maybe lumber will play out a little more, right? So here's the spaces I've talked about umpteen zillion times over the last few months. It's really just beginning to look like it may, at least in the short term, be leveling out. But in terms of the long term, still continuing on its pretty downward trajectory since the beginning of March. And we're looking at just daily charts here. I'm actually going to switch to a weekly, which I normally do, but not good for mortgage rates on really anything as far as borrowing capital goes. It's a retractionary or a pulling away of capital type of mode with these, even though the yield curve may be inverting or not, depending on the experts you listen to on TV. It's important to note that at least in the credit space, which is what this particular asset class is considered to be, as far as institutional investors on the street, it's, it's not good. I mean, the prices of the stuff's falling, for those looking for higher yield on their short-term cash, you will see increases in that. But that is far, far been offset with a much higher inflation rate playing out. So with the US dollar here, you guys could see we were stuck in a very tight range. And then we've just recently, the last few days, busted above the highs here. And, the euro consequently back down near the lows, almost everything. We look at the yen. I mean, this is crazy movements. GBP, we're back down to lows. Now, granted, we're only looking at a snapshot of about a little more than 1 quarter in this window. You could see here. But it does a really good job of just sort of putting together all of the different perspectives of how a lot of currencies, not all, but a lot of currencies have pulled back in the majors land in relation to the dollar, right? And a lot of this can almost exclusively be pointed to with disrupted conditions exiting from the pandemic all the way to, obviously the crisis in Ukraine. So hearts go out to everybody that's been affected by that. It's really quite a troubling sight to see. And let's hope it gets better quickly. That's really the bottom line. We're going to continue to be in a melees of decoupled, if you will, markets, which we've currently seen. So risk being high in almost all areas of the markets, almost every asset class as well. So, like I always say, cash is a position. Let me take a look at a weekly chart on this. I want to see a bit of a longer term. Usually just try and stick to the weeklies as far as what things are going, but it really puts things in perspective as far as how far we've come in the energy space, as you can see here, right? How much gold probably should have rallied more through this period of time, but it hasn't, right? It's been a real coal or canary in the gold mine, so to speak. But you could see how bonds over the long term were trending down. Now, in some cases, it's a precipitous down, even though some may say, well, you've only dropped from 110 essentially in the price of a 2-year note to 106, but that still puts a very unvolatile bond price that's dropped at least 4%, right? So that's still pretty significant drop for a very short term and typically a very low yielding type of credit instrument. Also puts in perspective where the dollars come, right? Look at that. You may actually see 100 on the dollar index in the next quarter. It could certainly happen. It's bringing all of these currencies as risk assets fall in. So most of these, at least from a trend standpoint, I would imagine as they rally back in whatever dead cat bounce they may seem to be in, hopefully some of our AP softwares are continuing to take shorts from a longer term perspective, because that's where we go. The trend is your friend, as they say. And oftentimes, as I've illustrated many, many times throughout the last 2 years almost, I've been associated with the AP folks. You really have to look and see sort of how this is all played out over time. A little more strength in Aussie land, right? Which I consider to be both these continents as well. All right, let's take a look at the news. Do a little Forex fact before we jump into the charts. Here we go. Make this a little easier to see. Okay, so we're looking at, just take a look at the week here. I know a couple of you commented you missed my trusty calendar, but you always want to know where you are. So essentially the end of Q1, beginning of Q2 into last week. And then, obviously we had the jobs numbers, which aren't due typically the first Friday of the next month, not always, but usually is one of the bigger news events. They are all trumped, obviously, by everything that's developing or undeveloping or ceasefires or back into full out war or whatever the particular case is with Russia and Ukraine right now. I was taking front and center stage outside of inflation. So those are the types of things in news that you want to pay probably more so attention. Of note was the election in France. Keep in mind, this is split right down the middle, you guys, right? So you've got the nationalists on one side with Le Pen, you've got the globalists on the other side with Macron. And surprisingly enough, the country is totally split. And never thought I'd ever make that statement for what it's worth, but that is the situation. All right, so I really only care about red folder events, and honestly, I'm not really going to know outside of anything Fed-wise, which takes place on Thursday. So what you guys can see here is an ECB press conference. That's a big one to watch for the week. Do note holiday weekend here in many countries, okay? Not normally in the U.S., albeit Easter Sunday obviously is a big holiday. It's a holiday weekend. You will see lower volumes on Friday if you haven't sat through any of my forecasts before in the past. And you're brand new. I talked a lot in the past about how important it can be to stay away from trading when volumes are low. Okay. Why is that? Well, simply said, when volumes are low, news stories can have an exaggerated effect on an expansive part of the market. It really can affect it in all different aspects of that. So you want to be careful during those periods of time. Almost seems like I could find a reason to be risk averse all week, right? I definitely can, because a lot of it is more baked in than it was to the marketplace a quarter ago, when the skirmish was starting to really heat up. Things were much crazier in that period of time. I can't say that the markets, the Forex markets have really begun to sort of digest this. But if you guys take a look on my Telegram channel, I've begun to post different opposing views of a couple of organizations I follow pretty tightly, a couple that we buy institutional research from. They're very good, like the Macro Compass guys. Really just big picture stuff, but without diving into detail, in this particular cast, this Monday, a sunny day with very low humidity in Florida Monday, I might add, which is pretty rare. Looking forward to it. The surprising thing I think that a lot of people have is that there's not more volatility of recent. Well, global events, depending on their severity, get what's called baked into markets. And if you've never sort of had a real basic discussion on finance or theory, the markets, generally the more liquid markets, right? Something like an S&P futures or an S&P 500 or CAC 40 or the stock 600. Any of a big international index, certainly the currency markets are developed markets, if you will, price all information in so that you can take nothing from it. So that's what's called the efficient market theory. You can Google it if you want a much more broad definition of that, but all known, and there's been multiple Nobel Prizes handed out on this, that most market information is known in the marketplace. So what effect can it have on it, right? Well, from a risk standpoint, markets sometimes will become complacent, and they will not, in a crazy period of time of news or what have you, they won't necessarily pay attention to it, right? Then maybe the markets didn't think the Ukraine was going to materialize into a full-on war between two countries, so they didn't price that in, but there was hints of it, right? The more complacent a market is, and then when things just start to, it's almost like a pot boiling over. It's getting to the top. You're like, yeah, I want it to heat up a little bit more, and all of a sudden the whole pot goes poof, and then the explosion, if you will, in risk happens very fast. So you can't really predict this kind of stuff, but that's why I always try and point out the severity of any given issue or any macro event in terms of the marketplace's view. So, the efficient folks, Markowitz, and, there's a zillion people that you'll see on the television channels touting their books that are what you call efficient market theory folks. Most of these people are of the believer that the market is an efficient place. All known information has been baked into the market, right? I will add that at least recently, I think that because of the sort of fat and happy, if you will, of a certain class of people globally, that the market's become lazy and complacent, right? And this typically which leads to disruptions in that. So, for now, there'll be events, driven in all different areas. Obviously inflation's taking center stage and political unrest pretty much globally. And obviously with the war and everything, but the bottom line is really the thing that I never take for granted is that risk can happen fast, right? And that's the faster it happens, the more you knew was complacent before that event materialized. So that's all I'm going to say on that subject. So that is my weekend rambling for you there. What else am I seeing here? So holiday week, at least in the US, varying degrees of people wanting to go on vacation. So I think, surprisingly enough, even though equity markets got pretty beaten up today moving into the charts, there's that dead cat bounce I was talking a lot about. So there's a lot of folks that hopefully had the opportunity to rally way back. Hopefully took some off the table if they were overweighted in equities in relation to the time frame for their money, right? You had a little window of time for it to happen. And then let's move down into the DXY. Skip past all the other equity talk, but I know we trade a lot of equity-based currency pairs and so forth on the MT4 platform, either with more of a manual trading pattern like the Arrow guys, or something that's more automated, some of our other software. In any case, as we had a pretty solid pattern playing out, essentially 99.75, capped at the bottom by a nice reversal off that. You have a significant reversal take place off of a support level, and then essentially the other time frame player stepped in and sort of brought markets out of that lower level. So we're in a much higher time frame at this point. So now it needs to be said, as we've sort of broken out into new territory, you've got to go back to much further ago charts to see where we were in this. Okay. So the argument always is if you break lower and you can't find any new sellers essentially down in these areas, and this doesn't necessarily have to be the dollars, could be illustrated in any chart, but essentially you have a level of support in whatever the particular instrument is you're trading or the security. It holds. Next wave gives out, which you can see right here. This is essentially a buy, by the way, right here. As I've shown a bunch in the past, we broke past a very important area. And granted, this was COVID, so a lot of people are like, well, how do you read into this? I don't know how much you would, but we broke past it. It provided support in the test back down. So that almost argues for, if we've tested the bottom of a big range on a weekly chart, we're going to go back up to test the other range. So typically, the auctioning process will begin to take us back up to the other side of that range, which essentially for the dollar is just right under that 102 level. So we saw it, but it's been a while since we've seen that level. And the last time we saw the level was the absolute height of the pandemic mania, right into the end of the first quarter of 20. That's when things were bananas. And it's consequently the single last time in almost a decade that we were real heavy in stocks here for clients. Why? Because we got clobbered to the tune of close to 35% of US equities, especially more in the smaller caps. And I was of complete confidence, along with a lot of smart money on the street, that the Fed was going to step in and backstop this with accommodations. And it was a great buying opportunity from a previous period of time where we were very bearish. And much to the disgruntlement of many clients that thought we were flat out wrong. As often is the case, we are against the herd. So I would argue we'll see this area. To what degree and how long we stay here, I don't know. That's a crapshoot. I mean, your guess could be as good as mine in this. But the point is I'm more arguing for being short of other majors and being long of the DXY, to quote Dennis Gartman. So consequently, here's the exact same opposite right down here of those highs we saw in the dollar. So I would be looking essentially for a test of this entire region, this whole 106, 1.06 hundred-ish area, let's say all the way down to the century point, which is right here. Yep. That's probably about as good as I'm going to get. It's like these century points are essentially every cent in this currency. I call it a century point or a century mark, right? The S&P goes to 6,000, it's hit a 6,000 century mark, right? Or big milestone, some people call it. Either way, these act normally the first time you touch these areas as a natural support and resistance point. Even though we may not have spent any time there, we've gotten to some big milestone in anything that will often serve as a support or resistance point coming into that. What else? Take a look at the pound. Again, we're spending times on weekly charts. Why? Because we haven't visited this time period in quite a while. So I wanted to make sure we had the opportunity to take a look at kind of where we are from the perspective of this. So essentially $1.30, almost perfectly. See that? We're there. It's support. Doesn't mean it's going to hold. Next stop, I would think, bottom of this lift right here. You can see how there's been 1, 2, 3, 4, 5, 6. Yeah, probably about 20 touches of this 2770-ish area. Now, a lot of it's been obviously way back in time, right? So the further back the touches to this area, the less, I don't know, relevance it has to the current area, right? But from a time perspective and a volume perspective, it was an area of support. More than likely to be a stopping point. Who knows? Maybe it stops and trends sideways as the dollar does, right? I'd be much more interested in this slingshot here, as I've been talking about the last couple of weekends. And this is more of a longer term chart you'd be trading off. But if you can recognize this type of pattern on any currency play, when you go into a big area, you get a bounce off that area, but you are in a defined trend down, right? Of any form. In this particular case, a defined trend form, down or up, is much more prolific, and it's in a weekly or monthly pattern, right? So you can play that off and have very little risk, essentially shorting the rips. In this case, it will rip back up. Was a decent short at that 3280-ish area. It's paid off handsomely. Look at US CAD, still inside that. So we had a defined trend down, seeing lots of rips. You could sell on the way down. See that? All those rips back up. Boom, 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 all the way down. Keep in mind, this is a weekly chart, so this is crazy how, now obviously it's pandemic stuff, but spiked up tremendously. Now it's lost a ton of value in relation to the Canadian dollar, but it's creeped back up, and I guess you could certainly say this whole balance zone it's been in from like 20 spot 2900 area all the way down to 2320-ish. It's been the zone. Probably will continue to be so until we get to an inflection point. I don't even know what to say is going on here. I don't know. Maybe this is that Taiwan thing, right? I just don't pay enough attention to it. I appreciate and I respect the spectacularness of this, right? But I don't trade it. But I can tell you this, just strictly from a weekly perspective, I don't know many times in the past that the dollar has been so strong in relation to the yen and actually bursted through the Bollinger Bands and ridden them up. See that? Essentially riding the Bollinger Bands up in this particular case. One, two, three, four touches of a weekly Bollinger Band. I mean, that is just stretched. And when it touched it the first time, got way above beyond it. This was one of the very few times, probably in 3 years of this, that I probably would have taken a shot short just because it's so extended, right? But this absolutely falls into the parameter of a statement I've made many times. That is one of the 4 top statements in risk management in all of finance. And it is the statement of markets can remain irrational a lot longer than you can remain liquid. So please be careful when trying to catch a falling knife. At some point, this is going to exhaust itself. This is where hedge funds blow up, trying to get too long of something, or in many cases, probably too short of this. And it's continuing to barbecue the shorts, right? There's other forces in play here. A lot of this has to do with the shifts in credit markets, obviously the Bank of Japan, a bunch of other stuff. In fact, I mean, quite frankly, I'm probably not plugged in enough to even have a decent enough risk discussion about this, but this is a really good point to illustrate, though. Let's take a look at Euro GBP. Seems like we'll never break out of this. Again, we're still weekly charts here. We're not even messing with dailies on this particular broadcast. We're just dealing with the long term here. GBP NZD, GBP CAD. Notice how we've broken out of a very long term. Hopefully, NEO has been mostly short in this trade. Let's see what's going on the daily here. It's like it's trying to find some footing here. Pound's been weak though. Gold. Maybe we're getting ready to race back up to the, actually, let me show spot instead. It sometimes makes it easier from the standpoint of the actual spot price market. Defined range, right? Maybe we'll burst up and visit this area. We spend some time over this area, maybe a day or two. A lot of the big shorts in gold are going to begin to get nervous. And this is usually when you hit those bolts up into a nice high area. The Bollingers can be exceptionally effective. Maybe not as much this wackadoo trade. This was a lot based on craziness in Ukraine. But as we come into touches of, on a daily chart, not as powerful, right? But if I go to the weekly chart on this, you can actually see the touches of the Bollinger Band, that upper band. Not only did we touch the Bollinger, we completely blew through it. I'm not a big fan of shorting gold, but just to illustrate the point, you know, you have a normal margin of standard deviation of price flex, if you will, just completely shot outside of that. There was a number of exogenous factors at work here, but these are the very, very few times in price where I will actually step in front of a train. That extreme out exhaustion is one of the very few examples. Oil, let's see where we've come over a long period of time. Oil in the short term here on the daily. I say if we crack through this, we'll probably see the lower range of the 70s. A lot of people are vying for that. I think this was outlandish. Triple short gold at the top, triple short oil at the top. A hell of a trade so far. And what else? I just take a quick peek at the mid fund here for purposes of analysis. You can ignore this one if you want. All right. I really thought we'd see more activity in the coinage here just because of, you know, the whole Bitcoin Miami event and everything. I thought you'd see more out of this. you know? Be curious to see what excuses they're given on stage. I haven't caught any of that crypto event. I'll usually wait for, a 5 or 10 minute synopsis of some of the best speeches, if there were any. But unfortunately, with a lot of these crypto events, for the serious investors that are interested in this as part of a diversification and a diversified portfolio, obviously, the fact these events just turn out to like Comic-Con where all the crazies come out, it just continues to solidify the lack of professionalism, if you will, in this asset class. I guess my hope would be, I don't know, I mean, this doesn't really matter a hill of beans, maybe much as a rant, but if you're an institutional investor and you are trying to embrace a new asset class, right? Maybe they invented a new metal, right? And outside of palladium, cadmium, and a bunch of other more exotic rare earth type stuff, you had a new metal come out, right? So if you're on a roadshow for this new metal, you want the big global investment houses to help host it and have conferences on it and, sort of build up investor interest and education along the way, right? The last thing you want to do on these roadshows is to have nutcases come out of the woodwork and just disrupting your show. It just doesn't bring, and this is totally a risk management discussion, by the way, because it seemed to me of some of the biggest global purveyors, if you will, of any of these crypto assets, and really it can start with some of the biggest brokerage houses that deal in this stuff, right? The Bitstamps, the all the different coin trading companies. It's almost like they should get together and develop sort of their own conference-based consortium and try and bring a level of institutional and professionalism to this. I think that would go just carry some serious weight as far as getting respect among institutional investors, because a lot of them, with the antics that go on in this area, they look at this and they laugh. They don't consider it a real asset class. And who knows? They could be all proven wrong, including me. And it could just have serious. But I can tell you, and you spend enough time watching. I don't care what channel in finance. There's 4 or 5 that I watch. Occasionally when things heat up in coin land, they parade the crazies around in front of the camera as well, right? I mean, this isn't me complaining about it. This is me saying, hey, if you want to be globally respected as a serious alternative asset class, it would behoove the biggest names in this, whether it be an individual or a company, probably the brokers, right, to get together and build some sort of consortium. Well, it does exist. Well, if it does, I haven't heard of it. So they're not doing a very good job in PR then, huh? In any case, I will end it there. If you disagree with anything I've said, I encourage you, please hit me up on Telegram. Let me know how I'm wrong. Always willing to listen to alternative and understand, try to make the research that I present forth to the AP community, in addition to our clients at First Down, better. So I wish everybody a great week. Hearts at everybody at Auvoria out to the residents and everybody that's been affected in the Ukraine. We wish you folks well. You guys are fighters. Keep it up. This is Steve Vetterl off the mic. May the trades be with you.
There is a substantial risk of loss associated with trading Forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.